Yeah, hello students. Now yeah. Yeah. Today I will explain introduction to finance statement, which is there in black to third unit. First of all, what is the meaning of financial statements? So financial statements are the formal records and summarizing the company's financial activities. They provide a clear picture of financial health and performance. These statements are assist stakeholders in making informed decisions. They are crucial for investors, creditors, management, and regulators. So this is the introduction about the financial statements. So financial statement means what? It is the financial records which is recorded proper way as per the systematic manner. So that is called as a financial statements. Okay. So here, what are the types of financial statements are there? And what is the objective of that financial statement? So that all are we are going to discuss right now. So before that, before discussion of that, we need to understand financial. We need to understand that financial statements. Right. So financial statement means what? It is a formal records and summarizing and a company's financial activities. So company involves of many activities. So these activities may be financial related, this may be a productivity related, this may be organization related, this may be management related. But financial statement talks about the financial activities related to stock transactions we are going to record and we are going to explain. So they provided clear picture about the financial health and performance. What is the company performance? How is the company performance? How it is, and what is the position of the companies? So that all are they are going to be recorded. Simply with the help of this financial statement, we are going to know that the company financial position and wealth of the company. And important thing is what is the objective of these financial statements? So, what is the objective of financial statements? See, main purpose of these financial statements provide the information about the economic resources and claims. Means what? What is the sources are there, where we can get the funds, and what are the choices are there, and where we can claim it. That all are we are going to learn. At the same time, also assess the ability to generate the future cash flows. So it means what? In future, what cash we required and what is the inflows are there, what is the outflows are there. It means what? The movement of cash. So where we are going to receive the cash and where we are going to pay the cash, that movement also, this be with the help of this financial statement, we are able to generate that based on the cash movement. For future purpose, we are going to generate the money. And what is the nature of these financial statements? So financial statement generally it is going to prepared on based on the past transactions only. Already whatever the data we recorded, we know the accounting rules. So we are going to record the data. First, we are going to collect the data, means recording only. After recording, we are going to classify. After classifying, we are going to summarize, we are going to interpretation. So there is a process, accounting process is there. So these all are with the help of that recorded data, we are going to prepare the financial statement. So that is the reason, based on past transactions, we are going to record. And quantitative nature, this whatever we are explaining, whatever we are recording, whatever we are analyzing, that in entire information is the quantitative nature. So quantitative nature means what? Which is expressed in terms of money. Monetary items only we are going to analyze. So that is the main purpose. Next one is the it estimates and judgments. So incorporate the managerial estimates. So this is the nature of the financial statements. And next one, what is the form of financial statement? Generally, some of the important financial statements are given here. But before that, I will explain all the financial statement. That is, first of all, balance sheet, income statement, cash flow statement, and statement of retained earnings and funds flow statements. Okay, and ratio analysis, trend analysis. So these all are we are going to analyze in the financial statements. So here the nature of the financial forms of a financial statement, generally balance sheet, income statement, cash flow statement. After that, funds flow statement, trend analysis, ratio analysis. These six are the very important. Some people they are going to show the statement of retained earnings also. So it is nothing but a change shows it will show the changes of the equity over a period of time. So what we are going to do in the financial statement? In financial statement, first analysis we are going to do, that is the balance sheet statement. It talks about the what is the assets and what is the liabilities and what is the equity position at specific period of time. So this balance sheet also we are going to analyze the two types of analysis, that is the comparative analysis of balance sheet and common size analysis of balance sheet. What is the meaning of comparative? What is the meaning of common size? Comparative analysis talks about the one statement, 1 year statement to another year statement. So this analysis also, there is a intra analysis there is a intercompany analysis also there. Intra means what? Same company balance sheet, present year to past year we are going to analyze. And intercompany means 1 year one company balance sheet to another company balance sheet we are going to be analyzed. So here comparative means we require two balance sheets, that is relating to the 2 year of 2 periods. So that is called as a comparative balance sheet. In this comparative balance sheet, we are going to compare with last year, what is the position of equity, whether it is increasing or decreasing. Liability side, we are going to check. And non-current liabilities, what is the position of that liabilities, whether it is increasing or decreasing. And current liabilities, whether increasing or decreasing. Year to year, we are going to compare. When coming to the asset side, assets, what is the position of fixed assets position? What is the position of whether fixed assets are increasing from last year to this year or current year to last year? And what is the non-current assets? What is the intangible position? What is the position of intangible assets? What is the position of current assets? So item wise, the classification wise, we are going to compare about the balance sheet. Next, coming to the income statement. Income statement also we are going to analyze two types of analysis, that is common size income statement and comparative income statement. Common size means what? When we are going to take the total entire sales is equal to 100. So individual item wise, that remaining revenue, what is the proportionate of in the sales? What is the expenditure in the proportion of sales? What is the operating expenses in the proportion of entire sales? So within the balance, within the income statement, when we are going to take 100% as the sales, that sales, what is the remaining component, what is the proportionate of that in that sales, we are going to do it. This income statement also two type analysis we are going to do, that is the common size statement, which is I told right now. And next level analysis is comparative analysis. Comparative analysis means what? Last year to current year. So 2 years data we are going to take. In the 2 years, we are going to find it. And next one is the cash flow statement. Cash flow statement talking about the movement of cash, inflows and outflows. Cash generally we are going to generate from the various activities like operating activities, investing activities, and financing activities. Activity wise, what is the cash inflows and what is the cash outflows? We are going to calculate the movement of cash, that is cash flow statement. Generally, this cash flow statement we are going to prepare two types. That is, first one is the direct method cash flow statement, and second one is the indirect method statement. So in direct method cash flow statement, we are going to talk about the direct cash inflows and cash outflows, whatever will come, that all are we are going to take. And indirect method, first we have to calculate the operating profit. Then we are going for preparation of investment activities, and then we go for the financing activities. So in operating activities, it will come only that relating to the business related transactions, whether receivables of cash and payables of cash. So whatever we are going to do regular operations, so that only we are going to take. So here generally we are going to take current assets and current liabilities, the change of current assets and current liabilities. After that, payment of to the debitor, the payment to the suppliers, as well as payment received from the debitors. This we are going to consider. And next one is the funds flow statement. The funds flow statement talking about the movement of funds. Generally, this funds flow statement, it is the broader sense. It will show the changes of position of the company. So simply here funds in cash flow statement, we are talking about only the movement of cash only. But in funds flow statement, we are going to talk about the entire movement of the current assets and non-current assets. And before starting preparation of this funds flow statement, we have to prepare the changes of working capital statement. So after changes of that working capital statement, we have to prepare the source and application statement. So here, in this case, first, how to prepare that changes of working capital statement. So to preparation of changes of working capital statement, we require that current assets and current liabilities. With the help of that current assets and current liability, we are going to prepare the changes of working capital. So simply, we are going to take that total current assets minus total current liability. The difference figure is called as a working capital. So for that 1 year to another year, whatever is changing is there. If whether last year were compared with last year working capital, current year is increased, if that is indicated that increasing of working capital. If the compare with last year working capital, if it is decreased, it is decreasing of working capital. So this way we are going to calculate the changes of working capital. And next one is the statement of sources and funds account. So what is the sources statement and what is the funds statement? Sources talks about the from where we are going to receive the funds. What is the major source of receiving of funds? That is one. And after receiving our funds, where we are applying, so where we are spending. So source and application statement talks about the mobilization of fund and application of funds only. So here, and one more statement also we are going to prepare. Before preparation of the source and application account, we are going to calculate the funds from operation. So funds from operation, we are going to calculate, we are going to take the net profit, and non-operating items, all are we are going to add, and operating related items we are going to exclude. From that, with the help of that items, we are going to calculate the funds from operations. This is the funds from operation. And next one financial statement is the ratio analysis. Ratio analysis, generally we classified ratio analysis means what? Ratio means the relationship between the two variables we are going to express in the mathematically. So numerically, whatever we are going to express the relation of two variables, that is called as the ratio analysis. Generally, this ratio analysis We classified four types. That is the current liquidity ratios, activity ratios, and leverage ratios, and solvency ratios. So profitability ratio, liquidity ratio, activity ratio, and profitability ratios. So these are the ratios which we have for the analyzing of financial statements. Next one is the trend analysis. Trend analysis is a very popular for calculation of year by year movement, whether the trend movement is increasing or decreasing. For that, to know that, we are going to use the trend analysis. So in the trend analysis, individual component wise, we are going to do. For example, if you take the fixed assets from last 10 years, when you started that analysis, the starting year we taken as a base year, and with the help of that base year for the next year, we are going to calculate whether it is increasing or decreasing. That is called as a trend analysis. Next one is the balance sheet. So whatever this balance sheet is there, again here I mentioned that. So balance sheet talks about the assets and liability. It will consist assets and liabilities. Again, in liabilities, equities also it is going to be consist. So the balance sheet flows of equation. Balance sheet follows that accounting equation, that is assets equal to the liabilities plus equities. For example, in 2023, the Apple balance of showed that $352 and liabilities are 276 and equity is the 76. So like this we are going to talk. And income statement. Income statement generally it consists that all the revenue nature, we are going to take the only revenue nature items only here. Revenue nature, revenue expenditures we are going to take, and revenue incomes only we are going to take. So revenues talks about the inflows from the business operations. Whatever amount we are receiving from the outside into the business, that is called as a revenue inflows. And expenses. Expenses talks about the whatever amount goes out. So that is called as a expenses, outflows of generating revenue expenses. So the difference between this 1 and 2, revenues minus expenses, is called as a net incomes. So net income we can calculate after calculation of revenues, after calculation of expenses. So that is called as a income statement. So next one is the cash flow statement. So before already I explained about the cash flow statement and funds flow statement. First, I'm going to talk about the cash flow statement. So cash flow statements, we classified based on that operations. Hello. Hello. The cash flow statements we classified into three categories, that is operating activities, investing activities, and financial activities. So operating activities, generally these cash flows from normal business of operations. So what is the receivables, what is the payables is there, that only we are going to take. And here next one is the investing activities. So investing activities talks about the buying and selling of the assets. So how much amount we are spending for the buying of assets, and what is the amount we are generating by the way of selling of assets. So this we are going to take in the investing activities. And next one is the financial activities. అన్నా చెప్పన్నా, నేను క్లాస్ తీసుకుంటానా? ఉంది, పంపిస్తా. నేను క్లాస్ లో ఉన్నా, పంపిస్తా. రైట్ రైట్ రైట్. ఎస్. సో here the investment activities talks about the cash flows from the buying and selling of the assets. So next one is the financing activities. Financing activities talks about the cash flow from the debt and equities. So whether you are in whoever investing your company, so that is cash inflows, financing inflows of financing activities. So whatever amount you invested in outside company, that is outflow of the cash. So here every company engaging these three type of activities from this, with the help of these three type of activities, we are able to find that movement of the cash inflows and cash outflows. Next one is the importance and users. So generally, what is the importance and who is the users? Generally, these financial statements are very useful for the investors for the purpose of make the investment decisions. So, and also it is very useful for the creditors also. They assessing the credit risk. And also it is very useful for the management of the operations. So if the management want to take any decision based on operation results only, they will take that. So for that, these financial statements help to users assessing the profitability and guide of investors and helpful for the lenders assessing credit worthiness, and they also ensure that regulatory compliancy. So this is the importance and uses of the financial statement. And what is the limitations? This final, when you preparing this, when you analyzing this financial statement, generally it is based on the past data only we are going to prepare. That is, it may be not predict for the future. And subjectivity, accounting methods and estimates are can be vary. So there is a lot of differences are there. And simplification, summarizing the complex information is very difficult to understand by the users. So these financial statements are very limited, being with the based on the historical data, and it is subjectivity accounting method, and they also summarize the complex of information, do not reflect the broader economic conditions. So this is the story about the financial statements. And next one is the methods of financial statements. So methods of financial statement, already I explained that. Methods of financial statement, I'll tell you that. Next one. Yeah. As of now, we discussed about the financial statements, that is balance sheet and income statement and funds flow statement and ratio analysis, trend analysis. Now, how it is going to be useful for companies and how it is going to useful for the investor, I will explain right now. Generally, that balance sheet, we are going to analyze the two types of analysis, that is the common size analysis and comparative analysis. So, methods of financial statements. We have six methods, that is the balance sheet analysis and income statement analysis and ratio analysis and funds flow analysis and cash flow statement analysis and trend analysis. Now, these financial statements are very helpful for the investors. So, whatever investors they want to take any decision, based on this analysis of financial statements only, they are going to take the decision. So, before the investing decision, before taking off investments, before taking off any decisions to invest in the any company, first as an investor, they want to analyze balance sheet. So in balance sheets also, what they are going to analyze, what is the position of the company. So generally this balance sheet we classified into two types of assets, that is fixed assets and non-fixed assets. Again, in fixed assets, we classified tangible assets and intangible assets. What is the meaning of fixed assets and what is the classification of tangible and non-tangible assets? So fixed assets means what? Whatever the company is invested in the uh, company for the long-term purpose. So to expansion of their business and to expansion of their productivity. So whatever amount they spent on their fixed properties, that is called as a fixed investment. Generally, this fixed investment again we classified into two categories, that is tangible assets and intangible assets. What is the meaning of tangible assets? Tangible assets means what? Whatever amount we invested on assets which on whatever assets which we are going to see and touch, like for example buildings which we can see that, and plant and machinery we can touch that. So whatever amount we are going to invest on these properties, that is called as a tangible assets, and that is tangible investments on tangible assets. What is the meaning of intangible assets? Sometimes instead of investing on fixed assets, we are going to invest on intangible assets also. Intangible assets like examples, copyrights, patents, and goodwills. So sometimes to expansion of our business, we are going to invest in the intangible assets also. So that is intangible assets. So these methods of financial statement, the first analysis is the balance sheet. So this balance sheet, we are going to analyze two types of analysis, that is the common size and comparative. What is the common size analysis? Common size analysis means we are going to take 1 year balance sheet, that entire assets or liabilities are we are going to treat it as a 100%, and individual component wise what is the proportionate of that total assets, that we are going to analyze. That is the common size analysis. And comparative analysis, comparative means what? To compare their required two statements. So here we are going to take the current year balance sheet and last year previous year balance sheet. So with the help of that previous year balance sheet, current year whether it is increasing or decreasing, that component wise we are going to analyze. So that is called as a comparative analysis. Same similarly, income statement also we are going to analyze two types of analysis, that is the common size analysis and comparative analysis. So common size, just now I said that whatever the income statement is there, that sales are equal to the 100%, which is we are going to take individual components, what is the proportion of that entire sales. So within the income statement we are going to analyze. And comparative statement means what? We are going to analyze with the another year income statement. So that is the income statement. Next one is the funds flow statement and cash flow statement. Funds flow statement is different and cash flow statement is different. Funds flow statement talks about the movement of funds. So before preparation of this funds flow statement, we have to prepare the changes of working capital statement and source and application of statement. What is the meaning of changes of working capital statement? So before knowing that, working capital means what? Working capital means what? Whatever the amount required to run the business or to run the operations, the day-to-day expenses, whatever incurred, that all is called as a working capital. So this working capital also we classified into two types, gross working capital and net working capital. Gross working capital means what? The entire current assets, the aggregate of current assets value is called as a gross working capital. And next one is the net working capital means what? Whatever that difference amount, that is gross current assets minus current liabilities, The difference amount is called as a net working capital. So we have to prepare the changes of working capital. Then we have to prepare the source and application statement. Then we are able to know the fund movement. Next one is the cash flows movement, cash flow statement. Cash flow statement talks about the movement of cash only. So this is purely talking about the liquidity position of the company. Generally, this statement we are going to prepare for the 3 months. And here the cash flow statement also involving three activities. That is the operating activity. Next one is the investment activity. Next one is the financing activity. So just now I explained that also. So next one is the trend analysis. Trend analysis talking about the individual component wise. So what is the starting year? Whatever the starting year is there, that year is we taken as a base year. And with the help of that base year, remaining years, we are going to know whether it is increasing trend or decreasing trend. So that is called as a trend analysis. So these are the methods of financial statements which we are going to analyze in the financial statement analysis. I'll give some more example also. See here. First, understanding the financial statement. First one is the balance sheet. Second one is the income statement. Third one is the cash flow statement. So balance sheet talks about it shows that assets and liabilities and equity of the point of time. So income statement talks about the revenues and expenses for the particular period of time. And cash flow statement talks about the details of cash inflows and outflows of the cash. Methods. Horizontal analysis. Generally, financial statement, we are going to analyze that horizontal analysis, vertical analysis, ratio analysis, and trend analysis. What is the meaning of horizontal analysis? Horizontal analysis talks about the track changes of financial items. And vertical analysis talks about the comparing lines items percentage on the base figure. And ratio analysis are assess the performance of risks. And trend analysis forecast the future trend analysis. So here I given some examples to understand that that is for the horizontal analysis, we require the data collection, gathering the financial data and multiple periods, and we are going to analyze that calculation changes and identify the trends. And vertical analysis talks about the base selection. Choose the base figure, for example, revenue or fixed assets or some other component, and need to calculate the percentage calculation and inside the extraction of comparing of the industry. And ratio analysis is the very important analysis in the company. So this ratio analysis we classified into four categories. That is the profitability ratios, liquidity ratios, solvency ratios, and efficiency ratios. Profitability ratio talking about the profit position of the company. And here we are going to talk only revenue related profits only, maximum to know the position of the company we are going to use. And liquidity ratios. Liquidity ratios, it is talking about the assess of short-term obligations. What is the liquidity position of the company? So what is the current cash and what is the current payments of the cash? What is the current receivables of the cash? So whatever we are able to generate the liquidity, that only we are going to talk. And solvency position. So solvency position talks about the long-term debt management. So whatever amount you invested in the debt equities, that debt equities talking about that how it is going to be generating the revenues. And next one is the efficiency ratios. So efficiency means what? Whatever assets we are using, whatever total assets we are using, whatever total debt we are using, according to that using value, whether they are generating the revenues or not, that we are going to talk. So this is the type of ratio analysis. Trend analysis talking about the movement of trends. First step, we are going to collect the historical data and gathering the relevant past information. Next, identify the pattern, look for the consistency movement and forecast for the future trends, predict market sentiments. This trend analysis forecast the long-term market sentiment. It helps to business prepare the market changes. It consider various forms of trends. Next one is the conclusion of this chapter. See, the financial statement analysis main the purpose of preparation of this financial statement analysis to know the performance of the company, to track the organization results. So that is the purpose we are going to use. And not only knowing the performance, we need to predict for the future. So if you know the current position, then you are able to predict the future. So periodic future outcomes for how it is going to be, where situations we are going to observe, what situations are we are going to see. Present, based on the past information, present we are going to predict for the future. And we are going to take the decisions, many decisions in the organization. So whether it may be investment decision, or whether it may be purchasing decision, or whether it may be acceptable or proposal, any decision for any decision making by the top level management, compulsory the management need to analyze and they need to study this financial statement analysis. When they understood this financial statement position, then only they are able to take the decisions. These financial statements are useful for the management and investor and outsiders. So how it is useful for the investors, how it is useful for the creditors, how it is useful for the management. So investors, see, in company, we are going to mobilize the funds from the investors only. So before taking the investment decisions, every investor, they need to understand the company position. So if any person, anybody of anyone, if the person is belongs to company, if they tell, the investor will not accept the proposals. Only when they will accept, when they see the financial statements, after seeing of that financial statement results, then only they are going to take the decision. So this is the investor point of view. And creditors, company engaging so many activities. Company requires suppliers, company requires debtors. So if you want to produce anything, compulsory suppliers will be required. When they produce the raw material, when they supply the raw material, then only we can produce the things or products. So here supplier and company relationship is very important. So some supplier, when they supply their products, they whatever the material supplied to the company, so company position is what? How much time they will take to payment that for the material. So what is the reliability of time to realize the amount? How many years it will take? How many months it will take? Whether the company's position is able to position or not? That all are they are going to identify by the using of these financial statement analysis. And next one, last item, last users are management. Management is the middle person for the company and outside users. So that all whatever decision they want to take, it is depends on the financial statements only. Sometimes when there is a poor performance is there in any department or any activity, so that activity they are going to shut down or going to discontinue, and where they will get the maximum results, they are going to continue with the good performance activities only. So this financial statement is useful for everyone. And this financial statement talks about the financial activities, how it is in the company, whether it is profitable or not, whether it is a good position or bad position. To know the entire financial position, whatever the financial activities which is expressed in the terms of monetary items, that all are we are going to analyze. So this is the chapter of financial statement. In next class, we are going to meet in the next block.